Meantime, stocks are turning higher this morning after coming off their worst session in about a month, feeding off of that bond market sell-off. Joining us here at Post 9 this morning, Sebastein Page, Rowe Price, head of global multi-asset and chief investment officer, also a former PIMCO executive vice president and author of the book, The Psychology of Leadership. Sebastian, welcome back. It's good to see you.
Thank you, Carl.
Bespoke points out yesterday, the third worst stock reaction to a bond auction in history. Was it a quirk about the 20-year, or is something larger really going on?
And it was small, too, just 16 billion. So, look, there's something going on. Rising rates are worrisome. They reflect worries about the budget, the bill that just passed, and it's basic financial math. Yields up, valuations down. Now, to put that in context, though, I'm not too worried about it. We are short treasuries in our portfolios. But I'm not too worried about it because, look, the long-term 30-year rate is actually not that far from where it is now.
Right. More about the delta coming off of the April levels? Is that what it is?
It's the delta. It's the acceleration. It's what's been going on in markets for the last few weeks, which is just a lot of extreme tail events. Big jumps on the downside, big jumps on the upside. Now it's coming to bonds, too.
Right. You do think on equities, valuations are kind of expensive once again, right?
Yeah, it's, blink and you will miss it. The market was almost flat in August, but you had 2 days where markets sold off by 10.5%. We've had 3 drops of that magnitude since World War II, and then one day popped by 9.5%. 2 such events since World War II. But April was roughly flat. We're back into fairly expensive valuation territory, especially given that growth is slowing.
So you're short bonds, but you're not worried about the move. Why? I mean, isn't it a signal that the fiscal concerns are back to the fore and the growth of the deficit is going to be a problem?
It's absolutely a signal. And by the way, like 7% deficits, that is recession-level deficits. We've just gotten used to this post-COVID. So these are real worries. I just don't see this as a cataclysmic, regime-changing event where, everything's going to fall apart because bonds in the 30-year are in the 5% range.
But they could go higher, I guess.
They could continue to go higher. We're positioned for that. Look, ultimately, we are close to neutral between stocks and bonds. We're positioned for 3 things. We're positioned for the market to broaden. So I think we're close to peak market concentration. Like 99% of history, the market has been less concentrated than it is now. We're positioned for tail events on both sides, big swings. So we like to be close to neutral. And we're positioned for inflation risk and some of these rising yields. So those are our 3 big themes in our portfolios right now.
Waller's on the tape this morning. He, once again, arguing that he thinks tariffs will be sort of a one-time shock. Do you agree with that?
I think tariffs are inflationary. They're, mathematically inflationary in the short run. I also think that in the long run, they do put some inflation pressures in place that can last over multiple years. I mean, you're reorganizing supply chains, and it's expensive to do. So I think on the margin, they're inflationary. But I want to say, though, the imports that are subject to tariffs represent about just 10% of GDP. And the market has been trading like tariffs are everything. And if you look at policy uncertainty for trade, it's tracking the S&P up and down. But let's not forget the remaining 90%. Like 70% of GDP here is services consumption.
Sure.
Right?
On that front, I mean, the retailers on a granular level will say nice things about the consumer, but serious delinquencies in Q1, auto delinquencies we're watching again. I mean, how much pressure is there on the consumer, at least the lower cohort?
There is pressure in a lower wage cohort. What is important to remember is that the top 50% of wage earners represent 80 to 90% of consumption. And at 4.2% unemployment call, that's lower than history. Like history is like 5.5%. So people are employed relative to history and claims, which I would look at claims.
Yeah,
as an
we did again today.
To follow.
Yeah, 227.
Like in the low 200s, the long run average for unemployment claims is 350. So as long as people are employed, I think the consumer can hang in there.
Right. These numbers continue to astound. Sebastian, thanks for coming in. That was good.
Thank you.
Sebastein Page.